Hello and welcome to another video where today I'll be taking you through a tax process for business mock exam. This walkthrough will be split into two parts. Part 1 will cover tasks 1 through to 4 and part 2 will cover tasks 5 through to 8. Just before we start, if you are looking for an additional mock exam to complete for this unit or any other units you may be studying, head over to my website willbaldman.co.uk and you'll be able to find them on there. Thank you to anyone who has purchased one so far. It is hugely appreciated. It helps to support the channel and gives you the chance at additional practice, so it's a win-win. Also, if you do find this walkthrough useful, be sure to give the video a thumbs up and subscribe to the channel for more mock walkthroughs and other accountancy related tutorials. Right, let's hop over to the exam and make a start. Right then, so the tax processes for business exam is an hour and 30 minutes, or you get up to an hour and 30 minutes to complete all 8 tasks, and the total marks on offer for this assessment are 80. Now, it isn't an equal split between tasks, but I'll be talking you through the marks for each task and what each task involves as we go through. Okay, so let's make a start then on task 1. So task 1 is worth 9 marks and is about understanding and calculating UK tax law principles relating to VAT, registration and deregistration and special schemes. Okay, so it can involve quite a few topics, this particular task. So this task contains parts A through to D. A VAT registered trader sold an item to a VAT registered retailer for £1,500 plus VAT of £300. The retailer sold the item for £2,300 plus VAT of £460 to a non-VAT registered business. Part A then, for 3 marks, complete the following statements. The VAT registered trader who sold the item for £1,500 plus VAT will include VAT of, and we've got to select between 0, 160, 300 and 460 as a cost to its business. Okay, so if the business is VAT registered, remember all they're effectively doing is holding that VAT for HMRC. So they would charge it on the product, so it'd be £1,500, and they would then charge 20% VAT on that amount. However, that's not a cost to the business because all they're doing is charging that, and then once the customer actually pays, you're holding that VAT amount to then pay on to HMRC. So the actual cost to the business would be 0. Okay, and that will always be the case if they are a VAT registered business. So moving on to the next bit, it says the VAT registered trader who purchased the item for £1,500 plus VAT sold the item for £2,300 plus VAT and will include VAT of, and then again we need to select from the same options as a cost to its business. Well, the same applies. So they have purchased this item and there would be VAT on this item. They've then sold this item and there would be VAT on the sale. Now, at all points of this transaction, they are just holding the VAT for HMRC. It is not a cost to the business. We can either claim VAT back or we pay VAT across, depending on whether it's output tax or input tax. So at no point is that an actual physical cost or expense to the business. So that would be, again, 0. Now the last one, the non-VAT registered business who purchased the item for £2,300 plus VAT will include VAT of, and we need to again select from these options, as a cost to its business. Now, this is where things are slightly different because now we're dealing with a non-VAT registered business. Now, because they are not VAT registered, they cannot claim the VAT back on this purchase. And because of that, that would be a cost to that business, okay, because they can't claim back that VAT element. Therefore, obviously, it is a cost to the business. So all we need to do for this one is calculate the VAT on £2,300. Now, we know this is at 20%, or it doesn't say anything about being reduced rate, so we can naturally assume that it is at 20%, and 20% of 2,300 would be £460. So the cost to this non-VAT registered business would be £460. Okay, remember, if they were VAT registered and they could claim that 460 back, then it would not be a cost to the business. But as they're not VAT registered, they are unable to claim that VAT back, and that would be the case for all purchasers if they are non-VAT registered. So that covers part A. Let's now look at part B. Identify which one of the following businesses may register voluntarily for VAT. So the specific part to this question is that it states may register voluntarily. So if the business has to register, okay, that will not be the correct option for this particular question, because this is asking who can register voluntarily, not who must register or who is compulsory in terms of registration. Okay, so our first option is a business providing taxable services with an annual turnover of 105,000. Now remember, for the Finance Act we are dealing with, the VAT threshold is on turnover of 85,000. So once you hit that 85,000, the business must register for VAT. So in this scenario, okay, this business has an annual turnover of 105,000. So they wouldn't be voluntarily registering for VAT. They would have had to have registered for VAT. So that would not be a correct option. The second one, a business making wholly zero rated supplies. Remember, zero rated are classed as taxable, and they have an annual turnover of £78,000. Now, because they are producing taxable supplies, they may register if they want to. There can be benefits for a business to voluntary registration depending on the types of goods that they make. Now, because their annual turnover is below the £85,000 threshold, but they do make taxable supplies, if they wish to, they may register voluntarily. So that would be the correct option. However, we will just check the bottom option as well, make sure that that is incorrect. So the last one states a business making a mixture of standard and zero rated supplies. The annual turnover from the standard rated supplies is 65,000 and from the zero rated supplies is 30,000. Now, combined, bear in mind both standard rated and zero rated supplies do count towards your £85,000 threshold. Combined, they obviously come to 95,000, 65,000 plus 30,000. So they would have gone over that VAT registration limit and therefore would have to register for VAT. Okay, so the second option is correct. Okay, moving down then to part C, the following three businesses operate special VAT schemes. A Limited has been operating the cash accounting scheme for several years. B Limited is a limited cost business and registered for VAT 3 months ago under the flat rate scheme. And C Limited has been operating the flat rate scheme for 3 years and is not a limited cost business. Part C, identify whether the following statements about the three businesses are true or false. 4 marks, so 1 mark for each statement. So statement 1 then, A Limited does not pay VAT to HMRC until money has been received from their customers. So that would be absolutely correct. Okay, remember this first statement here states that A Limited has been operating the cash accounting scheme. So we would only pay VAT or claim VAT back based upon what has been physically paid or received. So they're not using the accruals accounting method, they are using the cash accounting scheme for VAT. You could probably assume that they're also using cash accounting for their accounting as well, because it would just make sense. Okay, but all it means is that they're only paying or claiming back VAT based on what they've physically paid or physically received. The next one then, B Limited pays VAT on its gross turnover at a rate of 19%. Now, it states up here that B Limited is a limited cost business. Now, if you are a limited cost business, and this is one where your costs are extremely low, so this often could be if you're like a contractor, service contractor, such as like IT, where you might have really low costs. Now, if you're a limited cost business, you actually pay a flat rate of VAT of 16.5%. So it would not be at the rate of 19, so that would be false. The third one, C Limited, has bought one item of equipment, which includes £500 of VAT at the standard rate. C Limited can recover the input VAT paid. So it states that C Limited up here has been operating the flat rate scheme for 3 years and is not a limited cost business. Now, there are certain rules which state that although usually on the flat rate scheme you cannot claim input tax back on your purchases, that does not apply to some assets. If that asset is more than £2,000, including VAT, then we can claim the input tax back on that asset. So effectively, any asset that has VAT inclusive of over £2,000 will have VAT on that item of at least £333.33. Because if we calculate the inclusive VAT amount on £2,000, that's what the VAT comes back to, 333.33. So anything which has VAT higher than that, we can safely assume that the piece of equipment is over £2,000, including VAT. So in this scenario, it states that this piece of equipment has £500 worth of VAT at the standard rate. So we can safely assume that that asset is more than £2,000, including VAT, and therefore they can recover the input VAT. You do get some help on this within the reference material if you do need it. I do really strongly recommend that you familiarise yourself with the reference material. You do get access to it during the live exam. It just means that you're not having to remember absolutely everything, but just familiarise yourself with the format. It will be in the exact same style as it is in these mock exams. Okay. So then the last part here states both B Limited and C Limited are currently entitled to the 1% flat rate discount. Okay, now the 1% flat rate discount is only applicable in your first year that you join the flat rate scheme. Okay, now for B Limited, that is the case. It states that they are registered for VAT 3 months ago under the flat rate scheme. So this would be their first year, and they would qualify for the 1% discount. However, because C Limited has been operating the flat rate scheme for 3 years, it would not have access to that discount. So this one would be false. Moving on to the last question then for task 1. Daisy Properties plc has been operating the annual accounting scheme for several years. Taxable turnover for the next financial year ending the 31st of March 2024 is shown in the following table. And then the question states, identify the date that Daisy Properties plc must withdraw from the annual accounting scheme. Again, 1 mark for the correct answer. So if you are part of the annual accounting scheme, you need to deregister when your taxable turnover hits over 1.6 million. And the requirement is, and this is in the reference material again if you need it, and the requirement is that if you hit that 1.6 million, you must leave at the end of your financial year. So if we scroll up here, it states that taxable turnover for the next financial year and the financial year end is the 31st of March 2024. Okay. Now in this table, we've got the taxable turnover each month and the cumulative taxable turnover. Okay, and it's been nice and kind because it's given it basically from the start of the financial year. Okay, so our year end is the 31st of March 2024. So obviously the first month in this financial year is April 2023. Now we can see, according to the cumulative taxable turnover, that we will go over the 1.6 million limit in December. Okay, Now, in terms of when we need to leave, we don't have to leave immediately, but we have to leave at the end of the financial year. So if we look at our dates, okay, it states that our year end is the 31st of March. So therefore, because we have to leave at the year end, it would be that we need to leave at the 31st of March 2024. So that's task 1 done. Hopefully nothing too painful there. It is a case of just learning about the different schemes. Again, you do get information within the reference material that you can look at, so you don't have to literally learn everything. I do have a few videos out on these. I've got a flat rate scheme video and I've got a annual accounting scheme video as well. So I will link those in the description of this video if you want more information on both of those. So that's task 1 done. Let's now move on to task 2. So then task 2 is worth 8 marks, and this task is about calculating and accounting for VAT. This task contains parts A through to B. TAS Limited is VAT registered and sells a mixture of standard rated and reduced rated and zero rated supplies. Part A, complete the table to show the VAT and net amounts for the following supplies. Round down your answers to the nearest penny, and this is for 4 marks, so 1 mark for each box. Okay, so we can see that we've been given the gross amount, and we basically need to calculate the net and the VAT if it was a standard rated supply or if it was a reduced rated supply. So quite simply, when we're doing VAT, the net amount will always represent 100%. Now the VAT will represent either 20% if it's standard rate or 5% if it's reduced rate. And what that means is the gross, therefore, because it's the net plus the VAT, for a standard rated supply would represent 120%. Because the net is 100%, you're adding 20% of it on top, and therefore your gross is the equivalent of 120%. Okay. Now for reduced rate, because VAT is 5%, your net would be 100%, your VAT would be 5%, and therefore your gross would be 105%. That is really important when it comes to doing the calculations to work back to your net and VAT amounts. Now I fully appreciate for the standard rated supply, the sort of easy method to get the VAT is to literally take your gross and divide it by 6. However, that doesn't work for the reduced rate. So what we will do, and there are again other sort of cheeky little methods. However, I think we should be looking at this from a mathematical perspective because it will help further down the line with your other AAT studies. So we will do this calculation as we should from a mathematical perspective. So we stated that the gross under the standard rate of supply is 120%. So to get back to the net, all we would do is 420, which is our gross, divided by 120, because that gives us 1%. If the gross, I'm saying, is worth 120%, if we divide it by 120, we get 1%. We then multiply that figure by 100 to get the net, or 20 to get the VAT. So if we do 420 divided by 120 times by 100, that gives us a net amount of 350. And if we do the same again, but instead of multiplying it by 100 to get the net, and we do it by 20 to get the VAT, or you can just do the difference between the gross and the net, obviously, that gives us VAT of £70. Now on the reduced rated supply, because this is now 105%, we would do 420 divided by 105 to give us 1% and multiplied by 100. And that gives us a net amount of £400. We can then repeat the same process. So 420 divided by 105 and multiplied by 5 to get the VAT amount, or just do the difference between the net and the gross, and that gives you 20. Okay. If you've got another method of doing it, you're more than welcome to do it. I'm just showing you how it should be done in theory according to the sort of mathematical way of doing it. It should show you that way in your books as well. If you've got your own method and it works, just stick with it. Moving on then, TAS Limited offers a customer a prompt payment discount if payment is received within 7 days. The customer is not VAT registered. Part 2, identify the effect on VAT of the customer taking advantage of the prompt payment discount. Okay, so let's think about this. This is the customer. Okay, so they're paying and they're buying something and it's being offered, and they've been offered, should I say, a prompt payment discount. Now, if they take that prompt payment discount, that will reduce the total amount, okay, the gross amount. So that's including VAT. So if they take that prompt payment discount, they will literally reduce the total amount that they have to pay, and that's also having a knock-on effect on the VAT that you're having to pay, and obviously the net. So if they take advantage of the prompt payment discount, the VAT on that invoice, because you're lowering the value, will decrease. Think about prompt payment discount. If we just chuck some numbers, let's say it was, I don't know, £500, and you were offered a prompt payment discount, I don't know, 5%, 10%, whatever it is, that's going to reduce that value if you take it. And that in turn, as I said, reduces the VAT on that amount. So the VAT will decrease. Okay, and then moving on to the next one. TAS Limited made the following sale on the 23rd of May 2023. Standard rate of goods of £120 plus VAT of £24, and then zero rated goods for £96. The customer has requested an invoice from TAS Limited. TAS Limited issues a simplified invoice to the customer. Part B, I, identify which two of the following amounts must appear on the simplified invoice issued to the customer. So under the rules for a simplified invoice, for each applicable VAT rate, and it states this in the reference material, we need to show as part of that simplified invoice the total amount owed for each VAT rate. So we have two in this scenario. We have the standard rate and the zero rated goods. So we need to show the total amount, the gross amount, owed for each of those different rates. So for the standard rate, it would be 120 plus VAT of 24. Therefore, we need to show the 144. And then for zero rated, obviously zero VAT. So it would also be the 96. Okay, again, that is given to you within the reference material. So you do have that to hand if you need it for your exam. Part 2 then of Part B, identify when TAS Limited must issue an invoice to the customer. So under HMRC rules, a business must issue an invoice within 30 days of the goods being supplied. So quite straightforward, it would be within 30 days. So that wraps up Part 2. Again, hopefully nothing too painful there. We can now move on to Part 3. So Part 3 then is for 12 marks, and it is about the recovery of input tax. This task contains parts A through to D. Part A then, complete the following statements for 2 marks, so 1 mark for each. Residual input tax is input tax incurred on purchases and expenses relating to, and we've got some options. We've got both taxable and exempt, exempt supplies only, taxable supplies only. So residual input tax relates to both taxable and exempt supplies. It's basically, if you had like overheads within your business, so obviously this applies to a business where they make both exempt and standard rate supplies, or should I say exempt and taxable supplies. Okay, now if you make both of them, you've got to think that there's going to be certain input VAT or certain costs with input VAT that cover both. So a typical example would be like factory costs, because if you're making those goods, some of which are taxable and some of which aren't, but then you're paying for a factory which covers both because you're making both, you've therefore got input tax that actually relates to both taxable and exempt supplies, and that is known as residual input tax. So then the next line states if a partially exempt VAT registered business exceeds the de minimis limit, the business can recover. We've got a restricted amount of input tax, all input tax, or no input tax. So it would be a restricted amount of input tax. So they do this proportionally. So all they do is they look at I know this because I actually used to have to do this. So if you make, as I said before, exempt supplies and you make taxable supplies, what they will do is they will look at the proportion. So if you, just keeping it simple, if you say made 60% of your supplies that were taxable and 40% that were exempt, and you had input tax relating to something that covered both, you could therefore claim back 60% of that input tax because you made 60% standard or taxable supplies and 40% exempt. So they do it on a proportion. It's not particularly complex. I mean, it can be complex, but it doesn't have to be that complex. Right, moving down then. So High Life Limited is a VAT registered business and has incurred expenditure, including VAT, at a standard rate, shown below in the last month. Part B, identify whether High Life Limited can recover the input tax or the input tax is blocked for each expenditure incurred for 4 marks. Okay, so basically, can we recover the input tax or can we not? Simply put. So the first one, hospitality provided to an overseas customer from Italy. So if it is an overseas customer, we are able to recover the input tax. If it's a UK customer, we can't. If it's an overseas customer, we can. Next one, a lunch provided to a former employee. Well, because it's a former employee, that would be blocked. If it was a current employee, that is feasible. You would be able to recover the input tax, but because it's a former employee, it would be blocked. And that's just around the rules on staff members, which it looks like this next one is going to apply in that sense. So an evening meal provided to an employee, because they are an employee, they would be able to recover the input tax back on that meal. And then the last one, attending a sporting event with a client from the UK. Because they are from the UK, it's classed as UK entertainment and it would be blocked. There is no magical way of remembering all of these. It is just something you need to learn. They can't go that wild on this. I think there's only really a certain amount they can test because there's just not that many in terms of the detail that they go into at AAT. So once you've learned them, there's really not that much they can do with them. So get them learned and you'll be absolutely fine. Moving down then, the accountant of High Life Limited has carried out a review of aged receivables at the end of the financial year to the 31st of March 2024 and identified some bad debts. High Life Limited does not operate any special VAT schemes. All supplies are standard rated. Payment terms are 2 months after the invoice date. Part C then, for each bad debt, firstly, identify whether they are eligible for bad debt or not eligible for bad debt relief. Part 2 then, calculate the amount of bad debt relief available and round down your figures to the nearest penny. If your answer is 0, enter 0.00. So important to read these questions carefully because there'll be so many people who just enter 0 and you won't get the marks, so you need to enter 0.00. Let's have a look at the first statement then and see whether they are eligible or not eligible for bad debt relief. So the first one, Purple Limited has total debts of £5,598, all of which are over 6 months old. A bad debt provision has been made. Right. So on this one, they would not be eligible. And the reason they wouldn't be eligible, so it is over 6 months, great, that's a good start. So we need to be over 6 months overdue to be able to claim this as bad debt relief. However, to be able to claim bad debt relief, you first need to write it off in your accounts. So simply making a provision would not be enough to actually claim bad debt relief. It needs to be actually written off to say, we will not receive this money. Okay, now because that is not eligible, the amount of bad debt relief available would be 0.00. Don't forget those. Now on the next one, it states Pink Limited disputed an invoice totalling £498 that was invoiced in June 2023. The amount has been written off in the VAT account. So it's been written off, that's check number 1. We just need to make sure that it is over 6 months overdue. So it's stated within the question that payment terms are 2 months after the invoice date. And this was invoiced in June. So it would be due at some point in August 2023. And we are now in March, at the end of March 2024. So if this was due some point in August and we're now in March 2024, that would be over 6 months overdue. So they would be eligible for bad debt relief. Now, the amount of bad debt relief available, we would just have to calculate the VAT on this 498. Now, it does state totaling 498. So it's the total or gross amount. So it's the VAT that is included within that 498. So to calculate that, we can either do the method that I did before, which is 498 divided by 120 to get 1%, times by 20, or if you want to use just a simple method when you're dealing with standard rate and we've been given the total or gross value, we can just divide by 6 and that will give us the VAT amount. So the VAT amount on this transaction would be £83. Remember, put your 0.00 in. So that one met both criteria and therefore we can claim the bad debt relief. And as I said, just watch out, make sure whether they're giving you the total or the net amount or it actually gives you the VAT. Okay, it could vary within the question, so just read it very, very carefully to pick up on that information because that would be easy marks lost. Also, really, really watch out for this, the 0.00, because again, that would be silly marks lost for missing out just on that. Let's have a look at the last question then on task 3. So High Life Limited received an invoice from a supplier totaling £1,200, including VAT at standard rate. The supplier offered High Life Limited a 3% prompt payment discount if payment was received within 7 days. High Life Limited took advantage of the prompt payment discount. Part D, calculate the amount that High Life Limited can recover as input tax. And we need to round down to the nearest penny. And this is worth 2 marks. Okay, so 1 box, but 2 marks. Just because there's a couple of steps involved, so they've upped the marks slightly, I'm guessing. So let's think about how to calculate this then. So we know that prompt payment discount is calculated based on the total, including VAT. Now the total in this scenario is £1,200 and the prompt payment discount is 3%. So to calculate the prompt payment discount, which would be step 1, we would do £1,200 multiplied by 3%, or divide by 100 to get 1%, multiply by 3 to get your 3%. So the prompt payment amount is £36. The next step is to calculate the new invoice value because they've taken that prompt payment discount. So what they would do in terms of High Life, they would calculate that 3%, they would take it off this 1,200. So we'd do 1,200 minus the prompt payment discount of £36, leaving the amount to be paid as £1,164, including VAT. So we've now taken off the discount, but remember this was calculated on the gross. So our new value of 1,164 still includes VAT. Now a reduced amount of VAT, but it's still VAT. When I say it's reduced, it's been reduced from what it was at 1,200. So our last step is to calculate now the VAT amount on our new invoice value of 1,164. So because it includes VAT, either do 1,164 divided by 120 times by 20, or 1,164 divided by 6 to get the VAT amount included within that figure, which would be £194. So let's enter that in. So that finishes task 3. Let's now move on to task 4. So then task 4 is worth 8 marks and it is about preparing, calculating and adjusting information for VAT returns. Jazz is an accounting technician who works for a firm of accountants. Jazz is working on the VAT return for the Salt Design Company Limited for the quarter ended the 30th of September 2023. The Salt Design Company Limited uses the cash accounting scheme and the VAT return is completed using a software package. Jazz has entered a payment to a supplier totalling £529.20, including VAT at standard rate, as indicated on the invoice. The software has calculated the VAT as £88.20, whereas the supporting invoice shows VAT as £25.20. Part A then, identify the reasons for the difference by completing the following statements for 2 marks, so 1 mark for each statement. The invoice is, and we need to select whether it's correct or incorrect. So to know whether this is correct or incorrect, fairly straightforward. All we need to do is calculate the VAT on the amount that's been paid of £529.20. So we know how to do this now. We can either divide that by 120 and multiply it by 20, or simply divide it by 6. Now if we use either of those methods, that gives us a VAT amount of £88.20. So we know, looking at this question, that the amount that was calculated on the software was correct. However, the supporting invoice, where it's stated as £25.20, would be incorrect. So in terms of this question, the invoice is incorrect. The next part then, VAT has been included at the, and it's either the reduced rate, the standard rate, or the 0 rate. Well, it's certainly not the standard rate because we've just calculated the standard rate as £88.20. And it's obviously not 0 rate because the VAT on the invoice would therefore be 0. But it's been calculated at £25.20. So therefore, VAT would have been included at the reduced rate. Moving down to part 2 then. So identify one corrective action that Jazz should take for 1 mark. So we've got 3 options. They can either change the figure in the software to agree with the invoice. They can contact the Salt Design Company Limited to ask them to investigate with the supplier, or they can use the figure in the software and take no further action. So there's usually one obvious answer that we can eliminate, and it's certainly going to be in this one, use the figure in the software and take no further action. We obviously would need to take further action if the VAT on the invoice has been miscalculated. Now the first option, change the figure in the software to agree with the invoice, well, we definitely don't want to do that because the software figure is correct and it's the invoice that is incorrect. So we definitely wouldn't want to change what's in the software because obviously we'd be changing it to something that is then incorrect. So it would be our middle option, which is contact the Salt Design Company Limited to ask them to investigate with the supplier. And what we'd need to do is we'd need to get the invoice reissued with the correct VAT amount. So the next part states the Salt Design Company Limited invoiced a customer for £1,500 plus VAT at a standard rate of the 1st of August 2023. The customer paid for half of the invoice on the 15th of September 2023. The remainder was still outstanding on the 30th of September 2023. Part 3. Calculate the amount of output tax relating to the above transaction that will be included in the VAT return for the Salt Design Company Limited for the quarter ended the 30th of September 2023. Enter your answer to the nearest whole pound. So what's really important for this question is what it mentioned right at the beginning, which is that the Salt Design Company Limited are using the cash accounting scheme. If I just scroll back up briefly, we can see it here. I can't highlight it. Well, I could use the highlighter, but it states up here, uses the cash accounting scheme. Now that changes things because, going back down to this question, because the customer has only paid for half the invoice, they would only be accounting in terms of the VAT return for half the VAT. Because they're on the cash accounting scheme, they're only paying across, bear in mind this is output tax, the amounts that have actually been paid to them. Now, because only half the invoice has been paid, you would therefore only include half the VAT. Now, the VAT on this transaction was £1,500 plus VAT, so the VAT would therefore be £300. 20% of 1,500 is 300. Now, because they're on the cash accounting, we would only include, as I said before, half of this amount. So it would be half of the VAT of £300, and therefore, in terms of the VAT return, we would only include £150. Then the remaining 150 would go into the VAT return at the point at which it was actually paid. So calculate the amount of input tax, it would be £150. And it just wanted this enter into the nearest whole pound. So, moving down, Jazz has noticed that the bank reconciliation for the Salt Design Company Limited was not completed for the previous quarter to the 30th of June 2023. He has identified 4 transactions that need to be posted in the accounting software. Part 4. Calculate the changes that need to be made to the figures for output tax and input tax for each transaction. Round down your answers to the nearest penny. If there is no change, enter 0.00. Ensure you enter a figure into every box and do not leave any blank cells. Right then, so simply put, we need to calculate either the output tax or the input tax on each of these transactions. So again, just remember that we are on the cash accounting scheme. So for the first transaction then, on the 4th of April 2023, payment to a supplier totaling £90.24. The supporting documentation shows VAT at a standard rate. So a payment to a supplier, so we are dealing with a purchase and therefore input tax. So all we need to do is calculate the VAT on this transaction. Bear in mind that the £90.24 is the total or gross amount. So the VAT would be included within that amount. So to get the VAT amount, again, we know how to do this now. It would be £90.24, either divided by 6 or divided by 120 and times by 20. And that gives you a VAT amount of £15.04. And as I've already said, because this is a purchase, this would be input tax. We can claim this back. So it would be £15.04. The next one, on the 10th of May 2023, amount paid to HMRC for VAT for the quarter ended the 31st of March 2023 of £3,868.71. So this is simply the amount of VAT that was owed, that was paid throughout the quarter, and therefore it wouldn't affect your output tax or your input tax. Now, something that we need to do, and I need to do this on the first one as well, it did state within the question, do not leave any blank cells. So on this first one, I do need to enter 0.00. Now, on this second one, as I said, because this wouldn't affect your output tax or your input tax, because it's simply the payment of the amount that was owed to HMRC, we need to enter in 0.00 on both of these transactions. Now the next one, on the 28th of May 2023, proceeds from the sale of a computer for £300. The Salt Design Company Limited had claimed input tax on the original purchase. Now because they claimed input tax on the original purchase, we would also have to then charge output tax on the sale. Now if it's the proceeds from sale of £300, that would be the VAT inclusive amount. So VAT would be already included within that amount because proceeds is the amount that you've actually received. So again, same as what we did with the first one, we need to work out the VAT that's included within that amount. So either divide it by 6 or divide it by 120 times it by 20. And that gives you a VAT amount of £50. And because it's on a sale, it would be output tax. We can enter 50.00, and in our input tax, as I said before, you shouldn't be leaving it blank, so it should be 0.00. And then the last one, on the 1st of June 2023, a direct debit for the payment of electricity for £262.50. The supporting documentation shows VAT at 5%. So this is a payment, so it would be input tax. However, this time, rather than being at a standard rate, it is at a reduced rate. So we have done this one earlier. However, as a reminder, to calculate the VAT on a reduced rate item, we would divide it by 105 to get 1% and multiply it by 5 to get the VAT amount, and that works out to be £12.50. Now, because it's on a purchase, it would be input tax that we can claim back. So in our output tax, we want 0.00, and in our input tax, it would be £12.50. Okay, and that finishes off task 4. So that wraps up part 1 of this video. I hope you found it useful, and if you have, remember to hit that like button, and I will see you in part 2.